There is an old saying in finance that markets can remain irrational longer than you can remain solvent, but they cannot remain irrational forever. Eventually, the music stops, and when it does, the distance between the price on a screen and the value of a physical commodity becomes the most dangerous gap in the global economy. We are currently witnessing one of those rare historical moments where the map no longer matches the territory. To understand what is happening in Venezuela and why it matters to the money in your bank account, you have to look past the political theater of military operations and examine the quiet, boring mechanics of how the world actually prices its energy. For the last 40 years, the price of oil has not been determined by the exchange of physical barrels. It has been determined by the exchange of paper contracts. In London and New York, traders buy and sell futures, promises to deliver oil at a later date. This financial layer was designed to provide stability, allowing airlines to hedge their fuel costs and producers to secure their budgets. But over time, the paper market grew so large that it began to dwarf the physical market it was supposed to represent. Today, the volume of oil traded on paper is many times larger than the actual amount of oil pumped from the ground. This works perfectly fine, as long as everyone agrees that the paper is as good as the oil. It works as long as the market believes that if you really needed to, you could turn that contract into crude. But what happens when the physical supply is constrained by geology and geopolitics, while the paper supply is theoretically infinite? You get a dislocation. You get a situation where the price of oil remains managed and stable on the financial news channels, while the actual physical commodity becomes harder and harder to secure. This is the context for the American intervention in Venezuela. It was not simply a political move. It was a physical necessity born of a market that has lost its connection to reality. The United States has spent the last decade celebrating its energy independence, driven by the shale revolution. And it is true that America produces a staggering amount of oil. But oil is not a fungible commodity like gold or corn. It comes in different grades. The shale fields of Texas produce light, sweet crude. It is thin and easy to refine. However, the industrial architecture of the United States, the massive complex refineries that line the Gulf Coast, was not built for light, sweet crude. It was built 50 years ago to process heavy, sour crude. This is the thick, sulfur-rich sludge that produces the diesel, jet fuel, and heavy lubricants that power global logistics. You cannot simply swap one for the other. Running a heavy, crude refinery on light shale oil is inefficient and, in some cases, impossible without massive capital investment. For decades, the heavy crude that fed this system came from Venezuela. It was a perfect geological match. When sanctions cut off that flow, American refiners were left scrambling, forced to source widely and blend different grades to keep the machinery running. This brings us to the uncomfortable truth that the futures market obscures. You can print money, and you can print oil contracts, but you cannot print heavy crude. The paper price of oil might suggest abundance, but the physical reality of the specific molecules needed to run the American economy tells a story of scarcity. The raid on Venezuela was, in effect, a violent correction of this imbalance. It was an attempt to seize the physical assets that the paper market could no longer guarantee. But this move exposes a deeper fragility in the global system. By breaking the rules of international sovereignty to secure resources, Washington has inadvertently signaled that the market mechanisms we rely on are broken. If the global market was functioning truly efficiently, the United States would simply buy the oil it needs. The fact that it felt compelled to take it suggests that the price mechanism, the very heart of capitalism, is failing to allocate resources effectively. This failure is not isolated to oil, and we are seeing a divergence between paper prices and physical value across the commodities spectrum, from gold to copper to uranium. In each case, the physical inventories are tight, while the paper price remains suppressed or volatile, dictated by high-frequency trading algorithms and interest rate speculation rather than supply and demand. China understood this divergence years ago. While Western economies financialized, focusing on derivatives and service sectors, Beijing focused on the physical. They spent 2 decades securing long-term supply contracts for oil, lithium, cobalt, and copper. They built the mines, the ports, and the refineries. They didn't just buy the paper contracts, they bought the stuff. In Venezuela, China secured its interests not by occupying the presidential palace, but by integrating itself into the plumbing of the oil industry. They built the upgraders needed to make the Orinoco's heavy oil flow. They loaned the money that kept the lights on. They created a physical reality that persists regardless of who claims political power in Caracas. The danger now is that other nations are waking up to this discrepancy. The financialization of the global economy relies on trust that the dollar is a neutral store of value, and trust that contracts will be honored. When a superpower bypasses the market to seize resources by force, it tells the rest of the world that the market is no longer the final arbiter. It accelerates the trend toward resource nationalism, where countries hoard their physical assets rather than trading them for paper currency that can be devalued or sanctioned. We are already seeing central banks accumulate gold at a pace not seen in 50 years. They are trading paper assets for physical metal. They are opting out of the financial abstraction and moving back to tangible value. This shift has profound implications for the average person. We live in an economy built on the assumption of cheap, accessible energy and stable supply chains. If the mechanism for pricing these things breaks down, if the paper price no longer guarantees delivery, we enter a period of extreme volatility. It is not just about the price of gas at the pump. It is about the reliability of the entire system that delivers food to supermarkets and goods to doorsteps. The music that is stopping is the era of easy financialized globalization, where we could ignore where things came from and how they got to us. The intervention in Venezuela is a confession that the physical world still matters, and that it matters more than the rules we wrote to govern it. It is a signal that the era of abundance, or at least the illusion of abundance created by debt and derivatives, is drawing to a close. We are moving into an era of hard assets and hard choices. The United States has made its choice. It will use force to secure its standard of living. China has made its choice. It will use infrastructure and long-term economic integration. The rest of the world is now watching to see which strategy prevails. But for you, the individual observer, the lesson is quieter and perhaps more urgent. It is a reminder to look past the ticker tape and the headline numbers. Do not confuse the price of a thing with its value. Do not confuse the stability of the stock market with the health of the economy. The divergence between the two is growing, and history suggests that when reality and financial fiction collide, reality always wins. The question is not if the correction will happen, but how painful it will be when the illusion finally dissolves. As we watch the geopolitical tectonic plates shift, we must ask ourselves, in a world where paper promises are losing their power, what do we actually own, and what is it actually worth? Would you like me to elaborate on the specific role of gold reserves in this transition to hard assets? Or perhaps explain how the Chinese M-bridge system technically bypasses the US dollar?